So the correlation factor between art and the S&P, contemporary art and the S&P, is around 0.1, meaning that when the S&P goes up, art prices don't necessarily go up, and vice versa. The highest correlation between art and any other asset class is actually gold, which is around 0.3. So it acts as a really good diversifier in a portfolio to generate returns that are not necessarily correlated with public equities, which I think in today's world is really valuable.
All right, welcome to a very special edition of OK Computer. I am Dan Nathan, joined by my special on the tape and market call friend, Guy Adami. Guy, how are you?
What up? What up? Love to be here on the OK Computer. It's my favorite Pearl Jam album.
All right, there you go. That would be Radiohead, but it's just really a riff on their 1997 album, OK, OK, not OKAY like we do for the podcast here. But we are having a special pod because Guy is with me. Normally we do those other pods, but he's dropping in today because there's a lot of stuff going on in tech in the public market. So we're going to hit a bunch of that. I also have a great addition to our Funders and Founders series, but today it's just going to be Founders and Founders. It's going to be my good friend Scott Lynn. He's the CEO and founder of Masterworks.com. This is a complete platform for folks to invest in the art market on a fractionalized basis, and we're going to go into all of that. So stick around. It's a very interesting sort of asset class when you consider some of the other rates of returns of risk assets and how art has performed in different environments, inflationary, disinflationary, the whole nine. So stick around for that. All right, Guy, it is 2:00 on Tuesday afternoon. We've had a lot of very benign market days since the Fed cut interest rates nearly 2 weeks ago. We had that one big day where the markets just ramped. The S&P broke out to new highs. But interestingly, the NASDAQ never made a new high, and many of the leaders, and some of them in the semis in particular, have really lagged behind the S&P 500. Let's talk about that today, because here we are. The NASDAQ's down a little more than 2%. The S&P's down a little more than 1%. It doesn't appear to be on anything fundamental in the technology space, but there's two headlines. We wake up this morning and it looks like there's a proper war going on between Israel, Lebanon ground troops. The Iranians are launching bombs now over Tel Aviv and into Israel. So that's got investors on edge a little bit. Why is it that tech stocks are being disproportionately sold off relative to, let's say, some other names in the S&P 500?
Yeah, I think you're right to point that out. And that's obviously the headline grabbing news, as it should be, by the way. But I think but for that, we'd be talking about some of these Apple comments from two different shops in particular, citing maybe demand's not going to be as robust as initially thought. And I think the Apple story, quite frankly, in terms of what's happening in technology, should be the lead. And I think it makes a lot of sense because, if you think about it, there are far-reaching impacts or effects if Apple were not to be as strong, or if demand is not nearly as robust, to use that word again, as the market was anticipating. So the sell-off in Apple makes a lot of sense for a myriad of different reasons, but then the ancillary names, sort of the secondary names, make sense as well. And I think, listen, part of it is clearly what's going on geopolitically. I don't want to underestimate that, but even if that news was not out there today, I think you'd be seeing weakness across the board in technology.
Yeah, the Apple one's interesting because it's not like, Amazon, it's not like Meta, it's not like, Google, it's not like Microsoft, where these companies have been building out massive capacity, right, in their data centers, and they've been buying lots of servers, and those server makers have been buying a lot of high-end GPUs, and they've been buying memory from Micron and the like. That's kind of a different story than Apple. Apple's Apple Intelligence, this was their kind of AI strategy that they rolled out in June at their WWDC, was more about licensing this technology, and for all intents and purposes, it doesn't look like they're paying OpenAI for it. Maybe OpenAI's view is that this is a distribution sort of opportunity for them. Apple has a 1.5 billion installed base, but so Apple's not building out these models. They're not training them. They're not buying hundreds of thousands of these GPUs. And so that's probably a good part of the story. On the flip side, if you were looking to upgrade your iPhone, or the company was relying on this Apple Intelligence to cause a massive upgrade super cycle, as a lot of the analysts said, this is not it. This is not a product that is actually going to ship with this sort of stuff. And I've been saying this for a while, and you've been saying it. And we said it in June of this year, right after his launch. This is probably not going to ship properly on the phones until 17, which is a year from now, Guy.
Yeah. And if you think about it, though, I mean, we might have been right in terms of our assertion and the import of it, but we clearly, at least I was clearly not right in terms of the impact of the stock, because you go back to June 10th, and Apple, I think, closed that day around 195 or so. The next day, it was trading either side of 193, and that actually made sense to me. I thought it was going to be a sell the news event, and that lasted for about maybe less than 24 hours. Then the stock subsequently went up about $40 or so and make new all-time highs sometime in July. So you can be right and be wrong at the same time. But I think we're going to wind up being right in terms of the prognostication, the importance of the cycle. And I think we're also going to be right in terms of the stock as well, because when the market sort of catches wind of, I think, what's going on, this slowdown here in the United States, the fact that Apple is an expensive stock, and maybe the valuation has gotten ahead of itself in terms of what services can do, and the I guess the contribution services will make to overall revenue. I think there's a real good chance that we round trip the entire move from June 10th or so.
Yeah, that would make some sense to me. And then when you think about the geopolitical stuff, you think about the disruption as far as the port strike. Now, obviously, a lot of these Apple iPhones ship that, they're coming in planes, they're not coming on boats, that sort of thing. But you could see a scenario where supply is also limited because of some of the stuff that's going on here. And it's just the last point I'll just make is like when you think about expected earnings growth of 11% in fiscal 2025 and maybe 8% revenue growth, with margins ticking up a little bit from 46%, which, by the way, is up from about 44 and a quarter, last year in 2023. So you're seeing some margin improvement. And I think you made this point on many of occasions. The mix shift is getting a little bit higher, right, towards software and services, which is a good thing. It's much higher margin. So that's the story for Apple Intelligence. I think you and I are both in the same camp that 30 times that expected growth next year, it might fall a little flat between now and next fall. And if you don't have the hardware upgrade super cycle, you're not likely to get the uptake in services. So 30 times seems expensive, 33 and a half times trailing. Let's pivot this a little bit to semiconductors. So NVIDIA was down 4%, a little more than 4% at one point. I see Dell down 4%. I see Micron down 4%. It seems like an AMD, same thing. I see like some profit taking in this trade. I think it's important to note when I say this trade, I mean this kind of generative AI trade. And we made the case on many occasions. It's very narrow in the public markets. You might be able to put your finger on, Guy, maybe 15 names that have really benefited from the narrative, and then about 5 names that have taken about 85% of the gains in market cap, which, to be fair, have been trillions of dollars in the last, almost 2 years or so. But why do you think today you're seeing, selling when there's nothing really out there that's fundamental?
No, I mean, the only thing I'll say this in terms of Dell, by the way, if you go back and look at what Dell has done since October, I mean, Dell became sort of the hardware portion of this entire AI trade, and the stock, I want to say, pretty much doubled from the fall into early summer, only to give the majority of that back. But what I took away recently, I think it was over the last couple of days, Michael Dell announced that he's selling about $1.2 billion worth of stock, by the way, which is his right to do. But when you see insider selling of that magnitude, I think it should make people at least take notice. And you can say, you know what, it's probably part of a program. It might very well be, but clearly, when somebody of that magnitude sells, you have to acknowledge it at least and sort of talk about it. I think Dell's a great company. At 113, I think it's in the middle of no man's land here. But I think you're right to point out that some of these AI adjacent trades since, I don't know, early summer have not traded particularly well. And then you go back to June 20th specifically when NVIDIA made its all-time high. And, that's a stock that went from 140 down to 90 over the course of, I want to say, a month and a half or so, culminating on that August 5th low, got a lot of it back, but now seemingly floundering around 116. So I still think there's going to be some trepidation around the AI names as we get continued into the rest of the year.
Yeah, I made this case on many occasions that Apple's up, 16.5%, Microsoft's up, maybe 13%, Google's up 19%, Amazon's up 21%. You have an S&P that's up 20% of the year. So those names are kind of underperforming if you think about it. Now, Meta is up, 63%. NVIDIA is obviously up 140%. So, there is, there's some dispersion as it's going on in this trade. And to your point about, Dell guy was $64 a year ago. It was up 165% at its highs, earlier this summer. And to your point, it just round tripped that entire move. And I just want to be really clear about this. So think of this. NVIDIA's high-end GPUs, they go into servers, and with that is a bunch of memory from Micron. The servers are made by Dell and Supermicro, and then they are basically sold to the hyperscalers, which would be Google Cloud, Microsoft Azure, and Amazon AWS. One other thing, Micron. You and I were talking about it. I think it was last week. They reported decent quarter, decent guide. The stock gapped up 15%. The opening the next day was the high tick. Okay. I think it got up to, I don't know, I want to say 118 or something like that. Today it's trading at $100. Both you and I could not basically figure out why the stock was trading that way on those earnings and guidance. And we said, don't chase it. We think it's a good chance it fills in the gap. Well, it's nearly filled in the whole gap. What is that sort of initial enthusiasm followed by just selling? What does that say to you in a story like this?
Well, I mean, it's what it says to me is what it said to me all along. I mean, Micron's a great story, but say what you want about Micron. Historically, it's been a stock that can be. It's a commoditized company, right? And it goes through cycles. And I think you're in the midst of one now. The move that we saw into June, like a lot of these stocks, was all AI based. I think we got up to $157 or so. And then, like everything else, it gave the entire move from the spring right back. This recent move on the back of earnings, all it did, Dan, was get us back to the bounce levels that we saw on August 19th, August 20th, off that August 5th low, which I think, if I'm not mistaken, was right around $85 or so. So, bounce back to 115. We traded back up there post earnings. We're giving a lot of it back. Personally, I think we're headed back to sort of the high 80s, low 90s, and we'll have another conversation when it gets there.
All right. Before we get out of here, we got to hit Chinese internet stocks. Okay. So we started last week, a whole bunch of stimulus. First, it was monetary, then it was fiscal. The Chinese government is trying to shore up their markets, try to give the economy a bit of a jolt. They're trying to kind of see, what they can do with the consumer that clearly been lagging a bit. If you look at this KWeb, this is a Crane shares, it's this Chinese internet, the top 5 holdings, Alibaba, Tencent, Meituan, JD, and Pinduoduo. When you think about those 5 names, they are very consumer-oriented web names in China. The KWeb is up 45% in the last month. A lot of those stocks that we just mentioned have gone from very near 52-week lows to very near 52-week highs. And, today, as we're speaking, I mean, Pinduoduo, PDD is the ticker, is up 6.5%. Alibaba is up 5%. The KWeb is up 4.25%. I mean, from utter despair to utter euphoria in a matter of 10 trading days or so. What do you take away from that? Because you and I have made this point. You can do all the stimulus, both monetary and fiscal, you want. In a short period of time, it's not going to work its way into the economy. It's not going to put more money in the pockets of consumers. So when you see this sort of price action, you're pulling forward that activity, and it's hard for that to catch up and kind of re-rate these stocks, in my opinion, Guy.
We've seen it before. I mean, you talk about KWeb, you're right. I think you just said it. Alibaba's 11%, but those top 5 names collectively are probably, I don't know, maybe 40% or so when you aggregate them. So that's your ETF, number one. Number two, in terms of KWeb, if you look at it, you can go back to November of 2022. It went from 19 in November of that year. I think it was trading north of 35 by January of the next year, within a couple months, I guess is my point. So we've seen moves of this magnitude. If you look at KWeb over the last 2 years, we've basically gone nowhere. Now, people will say it's making a bearish to bullish reversal. It's probably true. But at levels now, I think we're trading 35.5, 36. All we've done is get back to sort of a prior high. What I will say is this. I do think there's going to be an opportunity to buy these cheaper. We've seen it before, but I think you sort of try to stay with this trade on the long side. I think it's too much too fast given the magnitude of the move in a short duration, but there's clearly something going on there. And I think the market's probably completely underinvested in China because all you've heard for the last year is how uninvestable China is.
Yeah, no doubt. I mean, the sentiment got very, very poor there, but I like your take there is that you either in it, you stay with the trade, or you want to get in it, you wait for a little bit of a pullback. This parabolic sort of move, especially in stock markets in general, is not something that I think you want to buy into. That being said, Guy, it's just gone up every day over the last week or so. So again, there's FOMO here. A lot of people that feel like they're missing out on one of the cheapest trades in global equities, but I get it. All right, Guy, I really appreciate you being here. We just kind of hit what I think and you think are some of the biggest stories going on in the market, and it happens to be very focused on tech. And obviously, generative AI, this Apple story is going to continue to play itself out. I can't wait until we hear what the company has to say on iPhone deliveries. It's going to be probably at the end of the month or so, because I think we're going to be right, Guy, but who knows? All right, stick around for my conversation with Scott Lynn, the CEO and founder of Masterworks. All right, welcome back to OK Computer. I'm Dan Nathan. I am joined by my good friend Scott Lynn. He is the CEO and founder of Masterworks.com. Scott, welcome back to the pod.
Thanks for having me. Excited to be here.
Yeah, well, we have a little different format to the last time you were here. We're running this Funders and Founders series where we've been matching up people like yourself, find founders, and then an early investor and talk about a little bit of the relationship. But because you are a multiple time founder, we're just going to call this Founder and Founders series here. So, but we really want to do a few things here. I want to go through a little bit about your background and how you founded different companies going back, I think 25 years or so. You've had some really successful exits. What led you to create Masterworks? What were some of the dynamics in the art market that caused you to kind of really drill down on this? A very disruptive model, but there was also some macro trends that you were seeing outside of your love of art that caused you to create this platform. Maybe we'll talk about the macro a little bit, and we got to hit something that we were doing in September of 21 when you first came on the pod. We were talking about digital art, we were talking about punks, we were talking about NFTs, and I got to remember, but I don't think you had too favorable opinion of those back then, and I'd love to kind of check in a little bit about what you're thinking about them now.
So September of 21 feels like ages ago now.
It really does. And I'd love to hear about how your business has changed since then. But let's go back here. Let's start with this really quickly. What led you to become a founder? I know that you dropped out of college. You had some great ideas you wanted to pursue. And I think you went back even before that. You were really business-minded from some of our conversations. Like, talk to us a little bit about your founder's journey. I think you probably started late 90s, early 2000s.
Yeah, so I started, I started my first company in 96. I was 16, 17 years old at the time. And I think that the idea of being a founder back then, like, it wasn't even a conversation topic, right? Like today, people talk about founders, there are all these different people starting companies. How do you do it? What do you do? What are the secrets? And back then it just wasn't, it wasn't really a thing, right? Like I started my first company because I was really interested in the internet early days. For those people who are super geeky and go back, a few decades, they'll remember what bulletin board systems were. I used to run a bulletin board system with someone named John Linden, who's actually now the CEO of Mythical Games. And we were just kids in Kansas City who were really geeky and kind of thought of it as a hobby. And then as the internet started, we had very basic business ideas, right? Like we had this idea to create a homepage creation tool, which you might remember, like GeoCities, some of those companies. But all of our ideas we thought were more like hobby ideas. And then the internet started happening, right? Everything started getting bigger and bigger. There was real money chasing these ideas. And to a great extent, we were in the right place at the right time, and we were doing what we loved. And it just so happened to be work, but we would have been doing it anyway, even if we weren't making money. So that was kind of my early experience with I guess stumbling into starting something. And then eventually, after trying a bunch of different ideas as a kid, I came up with this idea for an online sweepstakes game that wound up becoming the most popular game on the internet in 1997, 1998, if I remember correctly. And And it was basically a game where we ran these banner ads that at the time were referred to as like Punch the Monkey. And it was the most popular ad campaign on the internet at that time. And we would basically spend $1 in advertising. We would drive people to this game. They would click around and we would make $1.50 on ads that they saw when they were playing the game, right? So it was this very efficient way of basically buying traffic to a website and then making more money on advertising than we spent on bringing the people there. So that, that was my very first experience. I was a kid when I was doing that. Like I graduated high school with, I can't remember, like 60 or 70 employees. The business grew rapidly to 120, 130 employees by the time I was, 18, 19, 20. And then poof, the bubble burst. So, I'm this kid in Kansas City making, I was probably making more mistakes than I was making right decisions, right? I wasn't a highly effective entrepreneur at the time. And I don't know if I am now, but at the time, and I'm running this company, and I remember like it was yesterday. So March of 2000 hit, and the market collapsed. And with our business, and this was true of a lot of internet companies, and I think there should be a case study done on this. No one's ever really done it. Nothing happened. Our business was totally fine. April goes by, May goes by, June goes by. We're literally at the company talking about how the entire market for internet companies has fallen apart and our business is fine. November of 2000 hits. And within November of 2000, 80% of our customers canceled in a 2-week period. And this is a business at the time that's doing, I think it was doing $80 or $90 million a year in revenue, $1 or $2 million a month in EBITDA. And it was just confusing, right? Like we had no idea what was happening. And I think what happened at that time was that one company spent money with another company that spent money with another company that spent money with the first company. They were all .com advertisers. And as soon as you took one company out of the equation, everything collapsed. And I'll never forget that. Like that was such an amazing learning experience to have this company that grew really big and then immediately fell apart.
It's interesting. I often say this, and it's not particularly scientific, but when I talk about that period, because I was trading stocks at a hedge fund in the late 90s, and we were just really momentum traders, but we were very focused on a lot of these names, the Yahoo, the Amazon, the Excite, the At Home. I mean, these companies all went public in that period that you just talked about. And at the time, they had revenues that was scaling off a very low basis. Obviously, they didn't have any earnings, but it was the promise of these names. And so I often say, at some point in early 2000, Yahoo jammed one too many banner ads, on their homepage, and the whole thing, for whatever reason, came crashing down. But the point that you just made is a really interesting one, and it's something I want to kind of draw into a conversation about generative AI before we get to Masterworks, because there was a lot of vendor financing. There was a lot of capacity being built out, the fiber and all this stuff, and lots of, servers from Sun Microsystem, and they were financing these to their customers, and they were going into these data centers that, remember Exodus Communications. It's kind of similar to what's going on right now. And so you had this massive capacity build. These companies didn't want to look back and say they built too little. They were being afforded to do that in the public markets until basically the jig was up at some point in 2000. And again, no one knows exactly why that happened. I think a lot of it had to do with the stock market getting just way, way over its skis. And when you think about this, the S&P 500 in 2000 only closed down 9%. The NASDAQ closed down like 38%. So just think of the bifurcation and what was going on, and remember we used to call them old economy stocks versus what was going on. I remember that. And so it was just kind of, it was a mania. You know what I mean? And so it's fascinating.
It was really, I remember where you're right. Like there was a point in time before kind of Nielsen ComScore, there's something called Media Metrics, and Media Metrics was sort of, the research team that ranked every website. And companies were valued based on their media metrics, unique visitors and page views. That was it, really.
Eyeballs.
Like, there wasn't much more science on that.
Wall Street analysts used to quote media metrics, and they would call this eyeballs. It's kind of like we work with community adjusted EBITDA. They were just coming up with shit to justify valuations. But what's also interesting, and maybe you have a point of view on this, the venture capital business in the 90s was so small. I mean, on a relative basis to what we have now, yes. And that's one of the reasons why companies just went public without really any earnings. Obviously, they had revenues off of a low base, but to get funded, they basically needed to tap, the retail and obviously the mutual fund, outlets. And so that's what's really changed right now. When you think about, we have Gen AI companies that are being minted at $1 billion, pre-revenue, some as much as, Anthropics is being valued at 30 to 40 billion. They have $1 billion in trailing. OpenAI has a trailing 3 or 4 billion, no earnings, obviously, and they're raising money at 150 billion. How do these companies ever grow into those valuations from the private markets to the public? Who knows?
Yeah, I mean, I think, look, everything is in cycles, and it definitely feels like within AI we're on the upward trend of the cycle, right? Like I don't know how or when that comes down, but yeah, I mean, you think of the 2000 bubble bursting, 08, 09, frankly recently, and now I think AI we're kind of on an upward trend of the cycle again.
Yeah, but let me ask you this, because again, I think it's fascinating. You just mentioned that in the late 90s, you probably made more bad decisions than good ones. You obviously had a knack for figuring out something that was going to work in this very nascent technology, right? And so, again, some of the things that you were doing are some of the biggest things on the web now, 25 years later, if you think about it, right? So, gamifying things has worked really well on the internet, like as long as it's been around, right? And it's been consumer facing. But, some of the things that I see are not that different than what's going on right now. If you think about, so you have the chips, and maybe the chips right now, these, high-end GPUs from NVIDIA, this is the picks and the shovels sort of thing, and they're going into the servers, right, that a Dell is making, which is going into the data centers, which is being built out by who, and then all the hyperscalers are licensing these models. They're putting them in their data centers. They're renting the compute. They're building at breakneck speeds because they don't want to look back and say, oh, we didn't have all this infrastructure built out. And at some point in the next 12 months, there's going to be massive overcapacity, and then you'll have a correction. I don't mean to the tune of 2000, 01, and 02, but at some point, there's going to be overcapacity. Does that make some sense? And it's very similar to what happened. And by the way, NVIDIA is doing a bunch of vendor financing. And when Microsoft invests in OpenAI, they're giving them credits back towards their cloud. The same thing with AWS with Anthropic. So it kind of seems fairly similar right now.
Yeah, I think it's an interesting point. Like the difference between being an entrepreneur now and being an entrepreneur in the late 90s is the speed that you can execute. Because everything is a service, right? In the late 90s, when we would start an internet business, we'd have to go to a data center, we'd have to buy servers, to hire network engineers, like we'd have to do, everything from the ground up. There was no service, there was no Slack, right? Like we used to use something called IRC to chat with. Like, all of these different components now of building a business exist in services, which is why you can have businesses go from 0 to $1 billion in valuation in 12 months. I think in some ways that also maybe creates more volatility, right? Because the barriers to entry are less for new people coming into these markets and competing. So I think there's more volatility in whether companies actually survive kind of post $1 billion valuation, but they definitely grow much faster.
Yeah, that's a really great point. And it really goes back to maybe the convergence of mobile and social and cloud, right? So in this 08, 09 period, because that really did exactly what you just suggested. It made the barriers to entry not particularly great. And the other point I think I really like what you made is like, in the private markets, there's plenty of volatility. You're seeing basically all these folks who left DeepMind or OpenAI or Google or whatever, they go out and they start new companies and they raise 100 million or 200 million and they have $1 billion valuation. Well, a lot of them are failing right now and they're being bought back in, they're acqui-hires and stuff. And so, yeah, it's like a fast fail sort of environment. And then in the public markets, it's a very narrow trade. There's about 15 names in the stock market that are benefiting from it. And, it's the top 5 that have accrued trillions of dollars in market cap based on where they sit. And I would say that their moats are so large. I don't know how a Google circa 2000 can come in and disrupt any of these companies. OpenAI and Anthropic might be them, but who knows? And so, I feel like all the points that you just made are really important. They haven't hit the public markets yet.
Yeah, I do wonder if, one thing I've always thought about is public EBITDA multiples, arguably have grown, right? They really haven't changed as you've seen volatility in a lot of a lot of companies increase to a certain extent. Maybe that's because of the big seven, right? Like they have such a big weight on some of these indices, but it does seem like companies are getting more volatile over time, and investors haven't totally appreciated that yet. I've had that thought for a few years. I don't know how to think about it exactly, but it does seem like that could be the case.
Yeah, well, the other point I'll just make, and I know you track this stuff very closely. I know that you have a really great network as it relates in the VC community, but also a lot of fellow founders. I mean, this private for longer thing is really interesting too, because we've had this huge drought in IPOs really since 2021, and most of those were these crappy SPACs that all went to zero, right? And I remember, talking to you at the time. I think you were just enough. You were going like this to bankers, a little bit of Heisman. You're like, I am not taking this company versus one of these, public versus in one of these shitty vehicles, But the private for longer is putting some stress, I think, on the VC, in their ability to kind of return, capital. So we'll see how that shakes out. We'll see if the market can hang in there in 2025. Maybe the IPO window opens up a little bit. All right, enough of the macro stuff. I really do appreciate your opinions. I think a lot of our listeners are just sick of listening to me talk about this crap. So I want to hear from you a little bit about like what led you to create Masterworks. What was your passion as it relates to the art market? Because I have to assume that your entrepreneurial sort of spirit and your experience building companies before it finally got merged. Well, you said that, not really. I mean, you were a hobbyist back in the 90s, which led you to build a company. What was it that put these two things together for you, where you thought there was a great opportunity to be very disruptive in something in the art market that just wasn't going on? You basically created this business model.
Yeah, so I guess going back to kind of my original story of my first business. So I started a different company after that called Ad Knowledge, which was an online advertising company. And I started, as I made money, I started collecting art. So I was collecting art in the early 2000s, and wound up building an important what today is a mid-century abstract expressionist collection for those listeners that know anything about art. And I've seen the value of my own collection grow over many years, I guess over decades. And there was a lot of talk in the early blockchain days about tokenizing assets. And at the time, I'd never run a regulated company. I really didn't understand how to think about different compliance frameworks around securitization, financial advice, et cetera. So I started diving into this tokenization idea, just with the very high level thought that these paintings that appreciate are very expensive and inaccessible to almost every average investor, right? Like your most interesting segment of the art market that provides the best risk-adjusted returns are paintings over $1 million. There's some paintings that are $10 million. There's some paintings that are $100 million. But these objects are just so expensive that in today's world, they're really just traded between whatever, centimillionaires, billionaires, people with a lot of money. And I still think today it's the largest asset class that's never had investment capital broadly defined in it. And I think that's what the opportunity is, right? You have a $1.5 trillion asset class that trades $60 billion a year, half of which is at high-end auction houses like Christie's and Sotheby's. But there's never been a way to invest in it. The only way a person can invest in it is that they have millions of dollars to buy a painting, tens of millions of dollars to build a portfolio. And the number of people that meet that criteria is single-digit thousands living around the world. So I just think it's this big opportunity to really take an outperforming asset class and make it accessible to everyone.
Will you describe the business really quickly for those who actually, are not familiar with it? I know that in the New York investment community, I know a lot of people who are very familiar with it. I know a lot of people who actually, they don't think of it as like a trading platform by any means. They think of it exactly how you're talking about it. They would love to have exposure to some of those paintings that you're talking about in the single digit millions range or above that, but it's just not something when you think about, you reach a level of, I guess affluence, there's certain decisions that you have to make about where you invest, whether it's in, assets, risk assets, whether it's in real estate, everyone is aspirational about things that they love, like art. But it's like, to your point, it's not something, how many paintings can you buy and put on your wall, right? So you came up with a model that gives people the ability to appreciate art, learn about art, but also invest in it from a fractionalized standpoint. Is that a good little summary about the mission a little bit, or no?
Yeah, that's the business, and the way that it works is we go out and we buy a painting with our own balance sheet capital, and we basically file that painting with the SEC as a public offering. So it's the same process that a company uses to go public. You can go to sec.gov, search for Masterworks, and see all of our S1 equivalents that are filed with the SEC. After that offering gets qualified, we sell shares in the painting. Offering closes, we then tell investors to think of these as 3 to 10 year holds. We have secondary markets that exist if people need to get out early. But in general, most of our investors are thinking of this as low single digit allocations of a portfolio to start. They're allocating 2%, 3% of their portfolio across a number of paintings, and then they're growing that over time based on performance.
So when you have a customer who gets in there and they understand the time horizon, right, for these investments, how often will they invest in another painting, right? I'm just curious, like the average customer, like what sort of exposure do they have? Again, if you start out at low single digits exposure, but you start doing more and more, and we're going to talk about appreciation, the history of it relative to other, asset classes and the like, but how often are they invest in multiple different paintings?
Yeah, I mean, people grow. We don't really think of it in terms of frequency. We think of it in terms of total growth as a percentage of their portfolio. So if someone starts out at a 2% allocation, generally a year later they'll be at 4%. A year after that they'll be at 6%. So that's how most of our investors think about it. Our asset allocation models, depending on risk tolerance, tend to recommend anywhere between a 5 and 15% allocation, depending on how risk tolerant someone is, and then how able someone is to have an illiquid allocation for a long period of time.
Yeah, and so you just mentioned that you register these just like you would, an IPO or something like that of a company. How does your business work? I mean, does it feel like an investment advisory? Like, is that part of it? And you guys, obviously, I know because I've seen it, you have a lot of detailed research about the market, about individual, I guess, different verticals. And then you really dig down on different artists and then different pieces of work. And then you have all this stuff about comparable, sort of to other risk assets. So talk a little bit about that. If you have a customer who comes in and they're really interested in this one offering that you have, what is the due diligence like for a customer, and what sort of interactions do they have with Masterworks about that?
Yeah, it's a complicated question, right? Because we're a regulated business. So we're an issuer in that we file all these offerings with the SEC, and then all of our investors are onboarded through our own internal RIA, which acts as the financial advisor advising investors on these different securities. So we have a research team that does index construction on the asset class, so we can understand overall how is contemporary art performing compared to other asset classes, and then within contemporary art, how are different artist markets performing. So based on that data, we can actually construct portfolios for people that meet whatever their investment criteria is for their portfolio.
All right, talk to me a little bit about, let's just call it, whatever data you have going back decades. How has art performed relative to, let's say, the stock market? Let's say the average return in the S&P 500 has been about 10%, right? Over the last, maybe it's a little lower actually, over the last, call it 40 years, and the like. And, we've only had, probably a handful of down years if you go back, 50 years to the early 70s or so, which is really astounding if you think about it. But when you think about the scarcity in the art market, that's actually a benefit for investors, right? And especially if you can identify certain trends in the business, or certain artists, or certain things that are about to pop off. Just a real quick one, and I think I've told you this, I worked for a guy at a hedge fund in the late 90s, and he was so exposed based on his income in the markets, but probably an investment portfolio, you know what I mean, in the stock market. It probably wasn't a 60-40 by any means. It was probably all loaded up in tech stuff, but he started putting money into contemporary art, and he was, kind of, spraying it around a little bit. And he's the sort of guy, if Masterworks existed back then, he would have been one of your biggest customers, if I think about it. And he would have tried to, learn stuff on Masterworks and then just kind of troll all the galleries in downtown New York, that sort of thing. So talk to me a little bit about, the returns and kind of, over the last, let's call it a few decades, and how does that make you think about returns going forward?
Yeah, so if you look at just post-war and contemporary art, and that's art created after World War II, right? Art created basically in the last 75 years. That segment of the art market has outperformed the S&P by about 30% over the past 25 years. So it's a 12 to 13% appreciation rate per year. Now, like any asset class, there's certain artist markets that have done better, certain artist markets that have done worse within that overall. But the performance is really interesting. And I think the thing that we find even more compelling than the headline appreciation rate is the lack of correlation to other asset classes. So the correlation factor between art and the S&P, contemporary art and the S&P, is around 0.1, meaning that when the S&P goes up, art prices don't necessarily go up, and vice versa. The highest correlation between art and any other asset class is actually gold, which is around 0.3. So it acts as a really good diversifier in a portfolio to generate returns that are not necessarily correlated with public equities, which I think in today's world is really valuable.
Yeah, by the way, I don't know if you've seen this, but gold makes new highs every single day, and that would be all-time highs. So that correlation,
I do see it.
Yeah, but that correlation to your asset class, I mean, a lot of folks suggest you should have low single digits exposure in your portfolio to gold. And I think it really helps kind of make the case for what your offering is. Let's talk about the macro here because, when you and I spoke all the way back in 21, but we've done other things in between then, interest rates were about to go lower, right? If you think about that. So the Fed said to battle inflation, we are going to basically start raising rates. And almost anything that had massively outperformed, whether it be SPACs, whether it be NFTs and crypto and high valuation tech stocks or whatever, as soon as the Fed hinted that they're going to start raising rates, they all started getting killed for all intents and purposes. Probably November 21 was the high in the stock market, but then you just saw everything that wasn't bolted down just started creating lower for the better part of 2022. And one thing that's really interesting, and a lot of folks, they're just not making this connection right now. From the highs in November of 21 to the lows in October of 22 in the stock market, NVIDIA, Tesla, Netflix, and a few others went down 70%. Think about that, right? So it just speaks to the overvaluation that we saw in the stock market. And so let me ask you, if you saw, an artist or a specific work go down 70%, you would think that, I don't know what you'd think. You'd think the painting had herpes or something like that. I mean, you know what I mean? So I'm just curious, when you see that sort of behavior, or when the NASDAQ went down 85% from its highs in 2000 to its lows in 2002, I would think that this is a much more stable sort of market, especially now that you have organizations like yours doing deep fundamental research and deep macro research. So now that rates are starting to come down, what does that mean for the art market?
Yeah, it's definitely it's a good question, and I would say the way I would characterize the art market broadly over the past 2.5 years is it's definitely been a soft art market, right? It's been the softest it's been since the early 1990s, and like anything, there's certain segments of the market that are performing better, certain segments that are performing worse. Interest rates are definitely having an impact on our prices. China in particular is definitely having an impact on our prices. 25% of the demand in the art market comes from China. I think that's probably going to be better here in the coming quarters with the stimulus in China. But those two macro dynamics have had an impact. So what does that mean to our investors? Most of our artist markets have appreciated low single digits instead of historically 15 or 20% a year. Now, taking a step back, it's actually not surprising because when you look at the data and when you look at how we talk about the characteristics of the asset class, we always go back to low correlation with public equities. So I think that's just one thing that retail investors don't totally appreciate, right? We see a lot of retail investors do what we call yield chasing, which is always chasing the latest high yield product. And I think the problem with that is it doesn't really lead to building a long-term diversified portfolio. So when we think about art's role in a portfolio, a lot of it is that low correlation factor. So when the S&P is not at all-time highs, art is actually performing. And I think that's how people should think about art, probably how they should think about things like gold. But that does, that's more of like a Yale strategy around asset allocation. But I think that does produce better long-term performance.
Yeah. And by the way, I'm just going to give this little disclaimer. Nothing said on this podcast is investment advice here. So we're drilling down on the business model. I thought what you said about China is really interesting for a whole host of geopolitical reasons. Obviously, the Chinese have had a difficult time accessing different markets, which wasn't the case, let's say, a few years back. But the stimulus that you just mentioned, if you look at the Shanghai Composite, which is obviously the largest stock market in China, it's up like 25% from a 52-week closing low just a couple weeks ago, or maybe a week and a half ago, to now, a 52-week high. You generally don't see stock markets. This is the second one of the largest stock markets in the world, kind of move that way. And you have to think that ultimately it will broaden out a bit to other risk assets, right? So if you feel this kind of tailwind, you know what I mean, as far as investing in risk assets, I think that's pretty interesting.
Yeah, and the thing in our world that people don't totally appreciate is that you can buy a painting in New York and you can put it on a plane and you can sell it in Hong Kong, and vice versa, right? So we do this all the time. We'll source paintings from other countries, we'll sell paintings in other countries. So it really is a global asset class in that case. So when you have a certain component of your buyer base, decrease or increase, it can't have a big impact on the market because people just start shifting their behavior based on that.
So you mentioned like how much art is transaction, right, in these auction houses, right? So it's Sotheby's and it's Christie's. And there was an article in the Journal, I'm sure you saw it, I think it was last week, and it was the art market is tanking. Sotheby's has even bigger problems. You kind of addressed the softness, and I think that, you and I talked about this offline a little bit. The market's it's not tanking by any means. That was just kind of clickbaity. But what's going on at a company like Sotheby's? Because, hey, full disclosure, the CEO, Charlie Stewart, is a good friend, and he's a great operator. But what are the dynamics that led to that article, and what's going on with these auction houses?
Well, I think it's definitely the wrong message. Reporters in the art market in general tend to conflate transaction volume of the auction houses, how much art they're selling, with prices in the art market, right? How is the asset class appreciating? So when you say the market is tanking, most people like you or I would think, oh, prices are dropping. But what they actually mean in those articles is that the transaction volume, the amount of art being sold at auction houses, is going down. And we saw this in 08, 09. We see this today. What happens generally, and you just have to think about the persona of your average collector that's worth $100 million plus. If they think that prices are soft, in general, they're not selling. They just choose not to sell. They don't have to sell. They're not forced sellers. And they basically don't consign things to auction houses. So auction house volume drops. So it's really a sentiment game, right? It's convincing these collectors that own $1 million, $5 million, $10 million paintings that now is the right time to sell, and that they will maximize price. And in today's world, that's just, that's an imperfect argument. Most collectors are very sophisticated. They understand that now is not the right time to sell. So auction houses like Sotheby's have just seen transaction volume drop. But that transaction volume will come back in a big way as soon as confidence around prices starts increasing, I think, in the coming quarters.
Yeah, it'll be interesting to watch. I mean, like focus, for folks like me, who are really kind of drilled into the public markets, we often are looking at other asset classes to kind of give some signals about, kind of what investor sentiment is like. And I think that, the Wall Street Journal, I know CNBC, you've been on CNBC a bunch, a lot of folks are just really enamored with the art market because, again, especially obviously this contemporary post-war, but the great masters, they're just training hands among oligarchs and, some folks in the Middle East and then some casino magnates here or hedge fund guys, for the most part. But I think it's really interesting stuff to kind of just basically drop in and hear what's being said about these other risk assets. So I got to hit something before we get out of here. I really appreciate that whole conversation about Masterworks and just the kind of macro situation that affects art prices. Very interesting stuff. You and I, going back to late 21, we had Packy McCormick, who's a great guy and a really smart guy and a friend. We did a pod with him, and we were talking about what's going on in the NFT market. And I think, it's kind of interesting. We just looked at like Bored Apes. They were all the rage. I mean, people were paying hundreds of thousands of dollars for these things, right? And I think folks like you and me were like, wait a minute, like something's kind of off here. And there was like thousands of them trading. And I just looked at the floor right now is on those Bored Apes. I think it was like 11.5 ETH. ETH is trading at 2,500. You can do the math there. And at the height, you ready for this? At the height, the floor was 150 ETH. Like, just think about that, right? And I think ETH was trading at like 4,000. So at the time, you were very skeptical about this. You did not like people making the, the comparison to what you were doing because you're fractionalizing art. Talk to me about just what it means to you to see this thing that was, considered digital art. We had that Beeple that sold for 69 million. People were really scratching their head at that. What does it mean to you as somebody who's watched the art market, very closely for a long time, and you've seen peaks and valleys, and some of the valleys that we just talked about weren't nearly as low in the art that you look at as some of the stuff that we saw in digital art?
Yeah, I mean, it's a good question. I mean, I feel honestly, I think the best way to describe it is just relieved that Masterworks never entered the NFT market. I mean, we had many conversations about it internally. We had lots of pressure from investors too. I mean, even on our onboarding calls with investors, I think the most common thing we were asked at that time was, "Do you do NFTs? Can I invest in NFTs?" And it was, there was a lot of pressure to do it. And I think fundamentally the reason we didn't do it is we could never, very simply, we could never construct an index on NFT price appreciation that we were comfortable with. We tried it lots of different ways, and it was very complex because there's lots of NFTs that go into these marketplaces that never sell. There's a bunch of wash trades on blockchain that you can't actually tell if something really sold or if it didn't sell. And we just couldn't get comfortable with the data. So if we can't construct an index, we can't really understand how to think about appreciation rate, how to think about volatility, what the role NFTs play in an asset allocation model. I mean, we have people at Masterworks investing with IRAs, with retirement accounts, and it just felt too risky. And in hindsight, we probably didn't even appreciate how risky it was, right? Like we certainly didn't think things would be down 90% or 95%. But it was too risky for us. So I think hindsight's always 20/20, but that ultimately was the right decision.
Well, you're pretty steadfast in it. I know you're a pretty curious guy, so it made sense that you would kind of vet it given like the demand that you were seeing and given some of the prices and the momentum in it. Well, listen, Scott Lynn, I really appreciate getting some feedback or a little history on your. I've heard a bunch of it. I think it's pretty fascinating, some of the stuff that you were doing in the late 90s and the early 2000s and the creation of this business model because, again, it's very unique and it's not something that a lot of folks, who are looking for alternative investments might consider. So it's really great to hear, all the detail about Masterworks. I hope you'll come back, man. I really enjoyed the conversation. I know we went heavy on some of the comparisons between what's going on now in the tech markets and the private markets and the public markets to the late 90s and early 2000s. But again, that's my jam. But I learned a lot by listening to you about what's your jam.
Thanks, Sam.